Good afternoon, everybody. Pleased to be here to present our interim results for you. Moving on to the standard disclaimer and then on to our strategy. Just to remind everybody of the three pillars of our strategy. First of all, it's to continue to develop and defend Aivlosin, and we do that by targeting unexploited countries, territories, new species and new medical claims. So where we have swine, we might add poultry or vice versa. Second important plank and an important piece of the value in our business is the R&D portfolio. So we continue to invest to develop new products. We're focusing on swine and poultry, and we've got a great mix that will of high innovation and more standard technology, near term and medium stage that we'll talk about a little bit later. And the third pillar of our strategy is creating partnerships, strategic partnerships that can help deliver financial results via either acquisitions or via licensing out some of our technology. And both of those will help to develop our core strengths. And so those are the three pillars of our business. Next slide, please. Highlights for this period just reported. We had a revenue decline, but yet we were able to protect the profitability almost completely. In the revenue mix, we saw very good growth in the Americas, both USA, Canada, and Latin America. That was showing nice revenue. Going in the other way was markets in Asia, Thailand, and China for specific, mainly seasonal reasons, lower incidence of disease, and some customer churn. We continue to progress the R&D pipeline, and you'll see the maturing pipeline on a specific double click later. And we got some new claims and new territories for Aivlosin approved in Latin America in this last half.
Thank you, David. Chris Wilks, CFO. So going specifically to some of the financial highlights, David referred to the reduction in revenue. Specifically, that was 13%. When comparing the first half of the financial year 2024 to the first half of this year, being financial year 2025. Within that, a large component was foreign exchange. Around about 55% of our revenues recorded in US dollars, and that had an impact this period when the dollar was weak or sterling was strong, whichever way one looks at it, and that resulted, if you consider it on a constant currency basis, it was a 9% reduction period on period. Gross margins fairly steady at 40%. We've got a specific analysis of that in a few slides' time. And as David said, EBITDA held up despite that fall in revenue, so only a £300,000 reduction on EBITDA. The next slide on financial highlights, which goes to some of the balance sheet measures, cash specifically. Consolidated cash was £18.3 million at the period end. That included the components held in China. And as we've previously disclosed, the method for extracting cash from China is through an annual dividend. And once we declare that dividend, then that is clearly declared according to the shareholding of the joint venture in China, and we own 51% of it. Therefore, we lose half of that dividend declaration to our minority partner or our joint venture partner in China. So very useful to think about cash in the portion held outside of China, which is the £8.1 million you see on the right-hand bubble of these three. The significance of that number is that it is that fund which funds the new product developments, the R&D, which during this period was a £4.1 million cash investment in that program. We'll talk a little bit more about that as we go through this presentation. So the next slide, please, Hannah.
So just to elaborate a little bit on the revenue, mentioned that there was typically a slower summer period. We see that a lot Post-period end, we've seen seasonal increase in disease in China, and that revenue has picked up. Japan, we've got a lot of momentum in the business there, some excellent demand generation at the field level, and we are number one in our segment in Japan now, and reaching record highs in that country, and a very substantial growth there. In the US and Canada, very, very good execution, great demand generation, targeting the right segments of the market, and that is delivering results. Mexico, we had a slightly slower first half. We entered this half with somewhat more inventory in the channel than we had prior year, and we had some rotation of key accounts. So that dented the revenue in Mexico a little bit. Brazil, the larger and biggest component in Latin America, larger than Mexico and the biggest market there. We see strong demand there. We've even put on new key account business there. Some initial competition. It's a very price-sensitive market, but that has not impacted this first half results. In the balance of that continent, in other Latin America, we have done a couple of things to drive the business there. We have put some new distributors on, and they're beginning to deliver, and some existing distributors where we had some blocks to the business, we've removed those hurdles, and so that region is performing better than it had been. Europe, we had some logistic challenges in the first half, which slowed that down. That was due to putting on a new contract manufacturing in Greece, and routing of the product there was delayed due to VAT registration and other admin reasons. That is now underway, and that slowness is fixed and will reverse in the second half. South and Southeast Asia, we had a mixed performance there. We had very good growth in India, 9%, as you see there. But in contrast, we had some loss in Thailand, excuse me. That was a key account loss, so that balanced the growth in India was balanced off by reductions in Thailand. MENAF is a smaller region. Good growth could be executed there if we were able to, or the customers were able to access strong hard currency. So that limited a little bit of the progress in MENAF. Moving on to our revenue comparisons. Direct your eyes to the rest of the world revenue, showing nice growth there, period on period. And the bottom right chart, the sawtooth chart, explains the zigzags where we, in the routine of the business, we see a higher second half due to seasonal weightings than the first half. Varies a little bit from year to year, but it's roughly 40% in the first half, 60% in the second half. And that's our expectation for this year. It's a pretty consistent pattern to what we've seen in most normal years. Next slide, please.
So moving on to the investment in the future, the R&D expenditure. Those familiar with the story will recognize some of these numbers. We have a component which is capitalized and a component which is expensed. That references that portion of the portfolio which is late stage, which is capitalized, and earlier stage expensed. The accounting policies require you to capitalize where you have a high confidence of a successful outcome to your project or your development efforts. And in the case of you'll see later on, 3 latest stage programs, they are all being capitalized. We have a high confidence of a commercial outcome for those projects, and therefore they are capitalized as you see here. The split between the projects which are late stage and earlier stage, you can see is pretty consistent in these last few periods, an equal split of the funding between both those categories of projects. New this year, we've presented an analysis of the total R&D expenditure, both that being the total of capitalized and expensed, represented as a percentage of revenue. It's interesting to note that in our industry, there's a range of companies who are spending on R&D. The most you see is around the sort of 12% level, and the least you see for a company that's intent upon bringing forward new products is 8%. So you can see that we're in that range, and we're spending towards the top end of that range in this financial period. Moving on, please, Hannah, to admin expenses. Now, you note earlier on in our financial highlights that we recorded a fall in revenue of 13%, yet we managed to protect the EBITDA to within £300,000. How did we do that? Well, we did it through a saving in admin expenses, and in particular, the cash-based expenditure. What is the non-cash admin? Well, that is depreciation, amortization, and charges for share-based payments. So these are the sort of P&L charges which are not represented in a cash outflow. So of the rest, which are cash-based expenditure, how do we achieve that reduction? Well, some of it was arithmetic in the sense that everybody in this business has a component of their bonus which is associated with the financial performance of the business, and clearly, therefore, arithmetically, there was a saving there in the accrual we made for that bonus. Furthermore, there were some unfilled vacancies in the period which we didn't fill, and that therefore was an automatic saving in cost. And the run rate of expenditure in our marketing efforts was below that we'd previously budgeted and previously incurred in the prior period, and therefore that also was a saving which came through and helped to protect the bottom line. We move on to the next slide, please, Hannah. So to gross margin, and we present two things here. One for context, being the top chart. You can see the gross margin we've reported in this business over the last 6.5 or so years, and it's always been in the range of 40 to 50% of the maximum. 50% was anomalous. It was associated with a particularly extraordinary year in China, as a recovery year from the African swine fever pandemic in that country and the region, and that resulted in the restocking of the herd, high demand for the product, a real outperformance in that country, and that pulled the margins up. China, as you'll recall, probably is one of our higher margin territories. Normally, though, our margins are around the 45% level. In the last couple of years, the first half has been at the 40 to 41%, reflecting really the lower volumes going through in the first half. David mentioned earlier on the 40-60 split between first half and second half. Higher volumes normally result in a higher margin for the group. How do we compare period on period with regard to the gross margin? That's the lower half of this particular slide. 40.8% was the gross margin in the 6 months end of September 23, 40.3% in this last period. FX played a part in this. I mentioned earlier on that the US dollar, 50% of our revenue is in US dollars. So that had an impact of 2.2 percentage points on our gross margin, pulling it down by that amount. Conversely, we buy our active pharmaceutical ingredient, the key ingredient in Aivlosin, which is the largest input cost to Aivlosin. We buy that in US dollars, and so that acts as a very useful natural hedge to offset the revenue impact. Also, we managed to reduce the input costs of that active pharmaceutical ingredient in the year, and that contributed 1.9 percentage points to our margin. And then finally, the business operates throughout the world. There are some territories where we record particularly low margins, like Brazil, a highly competitive environment. The margins there can be down at the 30% level, whereas in our higher margin territories, they can be above 50%. So you can see that the particular components, the particular makeup of those countries, of those territories, do impact upon the overall margin for the group. But nevertheless, this year, we've held the margin pretty steady in the 40s. Now, moving on to the EBITDA bridge, which is the profitability bridge. The £705,000 was the EBITDA in the first half of September ending September 23, 445 this year. I mentioned earlier on the fall in revenue, and that contributed a fall of just under £2 million to the EBITDA. But that was compensated by the saving in admin costs, which we went through a little moment ago, and that added back just over £2 million. We chose to spend a further £250,000 in the R&D, the expensed R&D effort, and that is how you bridge across between the two profitability figures. So then switching gear and moving to the balance sheet. You see the balance sheet is characterized with the biggest numbers being working capital numbers. In the non-current assets piece, the intangible assets refers to the capitalization of R&D and some goodwill, which is a historic element of the group. The tangible asset, because of our business model, which is an outsourced business model, we are quite low in terms of capital intensity. So working capital, you see good performance in inventories, where the value of the inventories at the end of September 24 was £16.6 million, a reduction from the year end and a reduction from the equivalent period last year. And you see similar performance in trade and other receivables. I've represented the working capital in terms of days on the right-hand side, as I've previously done. Now, just a word of warning, this calculation is a simple average. It takes the figure in the balance sheet and divides by revenue or cost of sales, and represents that as 6 months. So clearly, it doesn't take into account the particular phasing of the revenue and when it fell. September 24 was a particularly strong month, and periods since September have been strong as well. But that skewed the calculation is represented here on the day averages. Cash you see there is a consolidated basis again. Cash flow statement it shows the effect of those balance sheet numbers and how they've unwound into this period from the year end. In particular, receipt of a cash inflow of £5.3 million from receivables, cash outflow of £5.6 million from year-end payables being paid in April. We were particularly low in stock at the end of March, as you saw, and that's therefore the payables piece coming through in this period. The number which is described as operating cash flow before moving to working capital, so effectively, what is the cash we've generated from our operating profits before taking into account working capital, you can see is fairly consistent and strong at £800,000 for the period. So then moving on to the R&D program.
So a double click on one of the hidden sources of value in the business. This gives you an insight into just part of our portfolio. On the left-hand side, you've got our products that are in the regulatory phase, so in the final phase of development. You've got 2 poultry vaccines there, Ecovaccine MG and Ecovaccine MS, which are globally relevant projects and targeted all across the world. The novel antimicrobial, that is targeted initially at Europe, and that's why the peak revenue number is lower than the other ones. In the hashed box, you have our mid-stage assets that are in the clinical phase, that's in animals, so beyond proof of concept, and in the clinical trial stage in animals. So looking at the final latter stage 3, they're progressing. We have organized with our contract manufacturing organization to focus on MS first. That's because MS has a more of a blue ocean playing field. The market is not supplied in the US. There are no vaccines for MS on the market in the US, and there's only one on the market in Europe, in some of the markets in Europe. So that's why we're focusing the production first on that, and that is progressing on nicely. We have been asked by the US regulatory authorities to do an additional clinical trial, and that's why the timelines for launch are under review. It's likely to be in the early part of 2026 for that, followed shortly thereafter by MG. And the novel antimicrobial, as it's targeted for Europe, slightly longer regulatory timelines in Europe, that will be 2027. We are going to do a capital markets day towards the end of the first quarter of 2025, when we'll give full flow through our entire portfolio and where the value is, but this really focuses on the key important stages. The right-hand side, which is our mid-stage, has got a number of high value, high intensity of innovation in there, particularly the MAB, which stands for monoclonal. The last two here are monoclonal antibodies, targeting in PRRSV, targeting an enormous market in the billions of dollars, damage to the industry caused by that virus. So you can see there's a huge market for us to go at. There are vaccines on the market for that, but there are plenty of opportunities to improve the performance of those, and that's where we see some considerable value in the pipeline. The enteric disease biological also has a monoclonal piece. We know that it works in chickens, and we have a mass administration application that looks to be very cost effective, and that's targeting a disease that is in north of $4 billion global damage to the industry, and no new ways of controlling that disease, no vaccines on the market of any substance in that one. So we've got again a great opportunity to deliver value from this middle stage pipeline. Just to complete that out, Ecovaccine PCV2 MHP, the one in the middle, that is one of the most damaging and challenging areas for pig producers. Again, a globally relevant disease. There is competition on the market there, but it's a market big enough for us to be able to achieve these peak year revenues. Just a note on the peak year revenues, the way that we factor this on the modeling is that it's 5 years to that peak revenue, and then we model that peak will be stayed at that peak for at least 10 years. The development cost is the development cost to go, so that's the remaining investment to complete these projects through to launch. Just on probabilities, we've mentioned already that when you're in the final stage of development, in the regulatory stage, the left-hand three, there's a very high probability of success here. You're into a high degree of confidence, well north of 90%. And then the projects that are in the clinical phase, we expect those to be entering that late stage in the next 24 months. And so when you first enter the late stage, probability of success is very, very high. First entry into regulatory, you're about 80% or 80 to 90%. So the point of this slide is to show that we've got assets that are near term, addressing significant market needs and a high degree of novelty, particularly in our mid-stage pipeline, with significant value to be delivered from that. Next slide, please. So we are a global business, so it's important to have values that we can cleave to. The collaboration value is very, very helpful for teamwork across the world. Our curiosity value sits very much at the heart and center of delivering innovation to the market, sits closely to our R&D colleagues, but also curiosity around how we operate the business, how we can improve the business, how we can do things differently and gradually improve. And commitment is about the commitment to finish the projects that we've got, to deliver the revenue that we are delivering in the business, and to strive forward with that. And we found in our internal engagement surveys extremely high levels of engagement, great numbers there, which shows that these values are beginning to deliver fruit for us internally. Next slide, please. These next two slides are very important to show what we are trying to do and, if you like, the investment thesis. So we have a global presence. We are a cash generative business from our licensed medicines that are spread around the world. And we've got a rich R&D portfolio with multiple projects in the pipeline. Our robust financial performance allows us to fund that R&D entirely out of cash. No borrowings, no need to do anything weird or wonderful there, coming straight out of the cash that the business is throwing off. So that's very, very, very important that we are able to do this and self-finance it. That said, we in our strategy that I mentioned, we do look for partnerships and acquisitions, partnerships where we could gain benefit from another partner helping us to commercialize these new products in certain areas where they may be stronger or have a deeper footprint or an additional portfolio beyond us. So we're in active seek mode for those, and also for if there are opportunities to license in or acquire products that are financially and strategically robust, we are also on the lookout for that. So that foundation of our strategy with partnerships and acquisitions, the new product that we've spoken about, and the ability to link our new products to our existing solutions gives us great confidence for the future. Next slide shows why are we in this market and why do we want to be in this market? Well, there are some fundamental structural and consistent drivers here, and that is population growth and GDP growth, and increased household income increases the demand and the desire for protein. So there will be increased meat consumption. We have to find a way to provide food for the more people that will be around in the world. And the first two most favored sources of protein globally are and will continue to be pork and poultry. So you can see the consistent growth of pork and poultry consumption on the right-hand side there, consistently going up. So it's a great place to be. And why do we want to be in the preventative sector? Well, the bottom graph shows the growth of the preventatives and vaccine part of the animal health market over the last 7 years and projected forward. So you see that the vaccine market, preventative market, is the area of growth. The other markets are growing, but at a lower pace, or generally growing. Some of them are a bit more flatlining. So we're currently in the anti-infective sector with Aivlosin, but we are going to go and get into the preventatives market. So it's a great and growing market. It's got some strong fundamentals. Demographic trends are right behind us, and we're entering into the most exciting part of the market, the preventative sector. So a good thesis for investment. So drawing it all together for the second half, we expect, as normal, we will see the seasonal upswing in demand. We have mentioned that we already have better pricing inputs so our cost of goods is on the reducing side. So that helps to support the margin. This gives us great confidence that the margin and profitability will be in the shape that we showed you earlier. And with good controls on the business, inventory and investment controls, all of that supports our forward profitability view. So in summary, solid cash generative business with a very exciting future portfolio gives us great confidence. And with that, I think we will close the formal presentation, and we are open for questions. Thank you.
Please, could you help us understand the key Thailand customer loss and the change in the distributor in Vietnam?
So the change in the distributor in Vietnam was to move to a more active distributor that will give us better customer access. In Thailand, this was a change in purchasing that was actually unrelated to ECO and unrelated to our products. It was a customer decision to write out or zero out all of the existing purchasing agreements and go back to recontracting for everything. And in the recontracting, we didn't succeed in gaining that customer for this half period. So future possibilities, but that's what happened in the first half.
Okay. Why are EBITDA margins for North America so much higher than for Latin America?
That's a market effect in many ways. Us, as the remaining animal health companies, Brazil is a low price, highly competitive, lower margin territory. So that drives the margin lower there. In the US, it is a higher price market. There is similar levels of competition, but we are able to execute slightly higher prices. It's a structural market effect rather than an eco effect.
Okay, thank you. When you take Aivlosin into a new market like Paraguay currently, would you expect sales to come from people who are switching from other products or from people who have not bought such a product before?
A balance of switching and brand new. Mainly, I would say the balance would lie in the direction of gaining customers. So Aivlosin's benefits are that it is a modern product. You need a very low dose, and it's highly efficacious. So if you've been using something before, you're likely using something that's not as efficacious, not as good, and won't apply. So the majority moving to a higher value, more efficacious, more modern treatment. Some non-use though as well.
Thanks. Can you confirm my understanding that CapEx in China over the next couple of years will be modest?
Yes, I expect so. We've got something specific in this next year, which we are contemplating, and that is the old factory. Those that have studied and heard us for a few years will recall that 2 years ago we rebuilt the factory. In fact, built a brand new factory next door to the old one. The old facility, it remains unused, dormant at the moment. There is the opportunity to consolidate our operations in the area. We have a remote warehouse, we have a remote office. So revamping that old factory, we can consolidate these operations all onto one site. And that will happen in this next year. Expenditure of the order of just under £900,000.
Okay.
But outside of that, there's no need for capital expenditure.
Sticking on the theme of funding, can the dividend from China be increased if cash is required for R&D?
There is a natural limit to how far you can take the dividend. You can only dividend up to your maximum distributable earnings. And the distributable earnings are tied to the earnings in the previous period. Our annual dividend averages between 70 and 75% of the previous year's earnings. And then, of course, you lose withholding tax along the way. We choose to run the joint venture without any gearing, without any borrowings. So therefore, we need to retain enough cash in that business to fund its working capital.
Okay. A couple of questions on competition. So it might be worth if you could take a moment to flesh out who the competitors are and how strong and effective they are as competition.
So there are some competitors that operate globally, and an example would be Elanco, listed on the New York Stock Exchange. They have a product called Hallas that they elaborate around the world. So that's one global competitor. There are a number of regional or local competitors that are smaller. So that's our current competition in the anti-infective segment. In the parasiticide segment in which we operate, there are both the same, some global players with similar offerings and some regional players. The intensity of competition to address that one, it is a fairly competitive market, and we are, that's one of the things that we are adept at, which is fighting in the trenches to gain share. And the way that we do that, some of these global competitors that I mentioned are somewhat older than Aivlosin, have a different technical profile, a different efficacy profile as a consequence, and so that's how we are. So we are able to differentiate in terms of what our products are and what our products deliver against both the global and the regional competitors. If I turn to wasn't quite in the question, but I'll elaborate a little bit further on the vaccine portfolio. There's different ways that we can differentiate. So some are underserved markets. So there for MS, for example, it's about market development and growing the market, and developing and growing the market. Others such as MG and the antimicrobial that we mentioned, there it's about delivering a differentiated offering to the market, a newer offering, and there's great value in vaccines often in having a very good strain of a recent strain. Some of the offerings that are currently in the market are quite whiskery, meaning they're quite old. They've been around a long time, and so bringing an up-to-date strain, an up-to-date vaccine gives you some of those differentiated advantages.
Okay, thank you. And when you refer to API costs, do you mean the active pharmaceutical ingredient?
Yes, that is what we mean, yes.
Yeah, lovely, thank you. Looking forward, are there any obvious gaps in your portfolio or products that you'd like to acquire, or are you better focusing what you have already?
Well, we have some gaps in our portfolio, and we definitely look for that. There are underserved markets. There are diseases and segments that we don't have in our portfolio, and also they're not around in some other folks' portfolio as well. So that could be a target. Or equally, where there is a good swine and poultry product that's serving a decent sized market, even with existing competition, there is still, as we've explained, space to grow in this market. So would we be better served? We are very deliberate to seek the right opportunity to make sure that it is accretive financially very rapidly. That's the type of opportunity we're looking for. But we can definitely increase our portfolio, and that would provide a good degree of operational leverage because we have a lot of the structure already, and we can put more revenue through the existing structure. Gives you a great degree of operational leverage.
Okay, well, focusing on getting the existing products through the pipeline, a couple of questions here on the USDA slowdown. Let's take the first one. The slowdown, which products will it impact, and does this raise any funding concerns?
So no funding concerns are raised. There's two factors to the slowdown. One is just administrative slowdown from the regulatory body themselves, slightly less responsive than they have been in the past. So that's slowing partly down. And also they've asked for, as I mentioned, some additional activity that they haven't previously asked for before, causing no concern in funding, but does cause some additional time, and that's particularly on MS. That's the specific extra piece of work we need to do relates to MS. So that's an additional trial on MS is in essence what has been requested, and that's the main effect there. So the USDA regulates the preventative segment of the market in the US. So that's our regulatory body for the US.
And the second question is, if you're seeing a bureaucratic impact, are you revising your approach with future products and where you'll seek approval first? Will you look perhaps to Europe instead?
Very good question. And the answer is yes, yes, and yes. So other places and indeed Europe. So we chose the US because it is typically a faster regulatory pathway and also a substantially sizable market. Where those timelines are going to be more favorable to move to another authority, and the most obvious one is Europe. We are absolutely looking at that.
Okay, thank you. As you consider distribution of the products nearing the end of their development pipeline, are you having conversations with potential partners, and when might we expect to hear an announcement?
So we are. We've had recent conversations with various different partners. So that's actively ongoing. Several of those have come to us because of some of our public activity, such as this and other presentations that we do. They've been interested in the technology we have, and they've come forward to us. Two of those, I would say, are in fairly early stages. One is in more an advanced stage. I can't tell you exactly when, because of the stage they are at. But I would hope in the not too distant future, maybe the next 6 months or so. But it does depend on how those negotiations progress.
Thank you. Two more. How are you finding the hiring market? Have the vacancies from H1 been filled?
So we've filled some vacancies in H1, but not all, and that was some of the vacancy saving there. How have we found the hiring market? I've been very pleased. We have continued to be able to recruit talent into the business. Why is that? Well, I think some of it is because people like to work here. People like the story that we've got. They like the opportunities and the future development that we have going on in the business. So we haven't had, touch wood, any difficulty recruiting, and we've just been cautious about recruiting the right people at the right time.
And finally, are there measures you can put in place to mitigate Trump's potential tariffs?
Yes. Question I've had a few times recently, and the answer is yes. And the additional, more developed answer is last time, and it's fashionable in the news at the moment to talk about Trump taxes. But if you remember the last Trump presidency, we were not in scoped in the Trump tariffs that were imposed on some products importing into the US. So we weren't last time. Will we be this time? We don't know. But if we are, we do have some mitigation there so that we can either route differently or we can manufacture and add value to the product in, let's say, Europe or the UK on the assumption, and I think it's a pretty valid assumption, that any tariff of imported products from the UK into the US would be at a lower, if any, tariff than the proposed China tariffs. So summary, last time we weren't in scoped, and yes, we have mitigation opportunities even if we were scoped into that.
Super. Well, that's it for the questions. So it just leaves me to thank our audience for joining us and both of you for a very helpful Q&A session. And we look forward to 6 months' time and another catch up.
Thank you very much.
Super. Thank you.